Are you dreaming of packing your bags, retiring to a gorgeous chalet in the Swiss Alps, or finding a quiet apartment overlooking Lake Geneva? It sounds absolutely beautiful, doesn't it? But before you sell your home, before you book that one-way ticket, we need to have a serious, unfiltered reality check. You have worked way too hard for your retirement money to lose it to a tax bill you didn't see coming. And the question you need answered right now is this: does Switzerland tax retirement income? The short, direct answer is yes. They absolutely do. But here is the problem. Most people look at Switzerland and they see a tax haven. They think of secret bank accounts and corporate loopholes, and they assume their retirement will be entirely tax-free. That is a massive, dangerous mistake. If you move to Switzerland as a resident, Switzerland taxes your worldwide income. That means they want a piece of your pension, your 401k distributions, and your traditional IRAs. I want you to feel the weight of this fear for a moment, because what you don't know can completely wreck your monthly retirement budget. Imagine pulling $5,000 a month from your hard-earned private sector 401k, thinking it's all yours, only to find out that Switzerland is going to stack that right on top of your local tax return and tax it as ordinary income. Now, let's break down exactly how this works so you can protect yourself. First, let's talk about the type of income, because Switzerland treats different retirement buckets very differently. If you are an American moving over there, we have a very specific U.S.-Switzerland tax treaty. Under Article 18 of that treaty, private pensions and your 401k or traditional IRA distributions are generally taxable in the country where you live. So, if you live in Switzerland, Switzerland gets the primary right to tax that money. They look at your 401k or your traditional IRA and they try to match it to their own system. Usually, they view them similarly to what they call their second pillar or Pillar 3 occupational and private pensions. What does that mean for your pocketbook? It means if you take yearly or monthly withdrawals from that private 401k or traditional IRA while living in Switzerland, that money is taxed at the ordinary, progressive income tax rate along with any other income you have. But what if you decide to take a one-time, massive lump sum withdrawal from your 401k instead? This is where the rules get incredibly unique. If you pull a lump sum, Switzerland doesn't mix it with your regular income. Instead, they tax it separately at a reduced, special rate. But don't celebrate just yet. That rate can still range anywhere from 5% to over 30% depending entirely on one massive factor: where exactly you choose to live. You see, Switzerland does not have just one single tax rate. Your total tax bill is made up of federal tax, cantonal tax, and municipal tax. There are 26 different cantons, which are like states, and thousands of municipalities. If you retire in a high-tax canton like Zurich or Geneva, you are going to pay significantly more than if you choose a tax-friendly canton like Zug or Schwyz. Choosing the wrong town to live in could literally cost you tens of thousands of dollars on a large retirement account withdrawal. And what about your U.S. Social Security? This is a question that terrifies a lot of people. Under the treaty, U.S. Social Security benefits paid to a resident of Switzerland can actually be taxed by both countries, but the United States caps its tax at 15% of the gross amount, and then Switzerland taxes it as well. You have to navigate the foreign tax credit to make sure you aren't completely double taxed, but you must expect that Uncle Sam and the Swiss government are both looking at that check. Now, there is another hidden trap that almost nobody prepares for, and it is called the Swiss wealth tax. It's called Vermögenssteuer. In the US, you are used to paying tax on the income you make. In Switzerland, they tax the money you already have. Every single year, they look at your net worldwide wealth, your real estate, your bank accounts, your non-retirement investment portfolios, and they charge you a percentage on the total value. If you have a traditional IRA or a 401k that Switzerland recognizes as a qualified pension plan, those assets are generally exempt from the wealth tax until you start taking the money out. But listen to me closely, if you have a Roth IRA, Switzerland does not recognize it as a qualified pension plan. To the Swiss tax authorities, a Roth IRA is just a regular investment account. That means the money inside your Roth IRA could be hit with the Swiss wealth tax every single year, and the internal returns could be taxed as ordinary income, completely destroying the tax-free growth you were counting on. So, what is your actionable takeaway? How do you stand in your truth and protect your money? Number 1, you must model your retirement location before you move. Do not just pick a Swiss town because it has a beautiful view. You need to look at the cantonal and municipal tax rates for Zug, Schwyz, or Nidwalden versus Zurich or Bern. A distance of just 20 miles could mean a difference of 10% or more on your retirement income tax. Number 2, review your asset mix right now. If you hold a substantial amount of money in Roth accounts or non-qualified annuities, you need to speak with a cross-border tax specialist who understands both IRS rules and Swiss cantonal laws before you change your residency. Do not let the excitement of an international retirement blind you to fiscal reality. Know the rules, choose your location with strategy, and protect every single dollar you have earned.